You've just turned 62. You've got a 401k sitting at $480,000. You've got a Roth IRA with $95,000 in it. You've got a regular brokerage account with another $120,000. And you've got Social Security waiting for you, but you're not sure when to claim it. You're finally there. Retirement is real. It's not a dream anymore. It's Tuesday morning and you don't have to go anywhere. But then the question hits you like a freight train. Which account do I touch first? And suddenly, retirement, the thing you worked 35 years for, becomes the most confusing financial puzzle you've ever faced. Because the wrong answer doesn't just cost you a little money. It could cost you hundreds of thousands of dollars over the course of your retirement. I'm not exaggerating. The sequence in which you withdraw your money is one of the single most impactful financial decisions you will ever make. So today, we're going to break it down completely, step by step, account by account. I'm Max, and by the end of this video, you're going to know exactly which funds to tap first, which ones to protect as long as possible, and how to build a withdrawal strategy that keeps more money in your pocket and less in Uncle Sam's. Let's get into it. Why? Withdrawal. Order matters more than you think. Most people spend decades obsessing over how to save money for retirement. They max out their 401k. They open a Roth IRA. They invest in taxable brokerage accounts. They do everything right on the accumulation side. And then they retire and they just start pulling from whatever feels right. Maybe they drain the brokerage account first because it feels separate. Maybe they touch the Roth because they know it's tax-free and it feels like free money. Maybe they just take from the 401k because that's the biggest account and it makes sense in their head. Here's the brutal truth. Most of those instincts are wrong. The reason withdrawal order matters so much comes down to one word: taxes. Every account you own in retirement is taxed differently. Your traditional 401k and traditional IRA. Every dollar you pull out is taxed as ordinary income. Your Roth IRA, tax-free completely as long as you follow the rules. Your taxable brokerage account, you pay capital gains taxes, which are typically lower than income tax rates, but timing still matters enormously. If you don't have a strategy, you could easily end up bumping yourself into a higher tax bracket every single year. You could trigger higher Medicare premiums. You could make your Social Security benefits partially taxable. You could lose eligibility for certain deductions and credits. And here's the kicker. All of that can happen even if you're not rich by any traditional definition. You could be a perfectly normal middle-class retiree doing everything wrong simply because nobody ever explained the rules. That's what we're fixing today. Understanding your three buckets. Before we talk about which account to tap first, you need to understand the three fundamental buckets of retirement money, because almost every retiree has some version of this setup. Bucket 1. Tax-deferred accounts. This is your traditional 401k, your traditional IRA, your 403b, your SEP IRA. The money went in pre-tax, it grew tax-deferred, and now every single dollar you take out is taxed as ordinary income. These accounts also come with required minimum distributions, or RMDs, which kick in at age 73. Meaning the government forces you to take withdrawals whether you want to or not. Bucket 2. Tax-free accounts. This is your Roth IRA and your Roth 401k. The money went in after tax, it grew tax-free, and qualified withdrawals come out completely tax-free. Roth IRAs also have no RMDs during your lifetime, which makes them incredibly powerful for tax management late in retirement. Bucket 3. Taxable brokerage accounts. This is your regular investment account. No special tax treatment on the way in, but you only pay capital gains taxes on the growth, not the full amount. Long-term capital gains rates are 0%, 15%, or 20% depending on your income. If you hold investments for over a year before selling, those gains qualify for the lower long-term rate. Understanding these three buckets isn't just academic, it's the foundation of everything that follows. Because the game in retirement isn't just about having enough money, it's about keeping as much of it as possible after taxes. The conventional wisdom and why it's incomplete. You've probably heard the standard advice: tap your taxable accounts first, then tax deferred, then Roth last. And honestly, that's not a bad starting point. There's real logic behind it. The idea is that you let your tax-advantaged accounts, especially the Roth, compound for as long as possible before you touch them. Meanwhile, you use the taxable brokerage account first because it's already been taxed. You only owe capital gains on the growth and you're not triggering ordinary income taxes. Then you move to the tax-deferred accounts. You take what you need, pay income taxes on it, and continue letting the Roth grow untouched. And finally, you dip into the Roth at the very end, or pass it on to your heirs because it's the most tax-efficient money you have. That logic holds up, but it's too simple. Real retirement is more nuanced than a three-step sequence, and if you follow it rigidly without adapting to your specific situation, you could leave massive amounts of money on the table. Here's the problem with saving all your Roth money for last. By the time you reach your 70s and 80s, your RMDs from your traditional accounts could be enormous. If you let that 401k grow untouched until 73, you might be forced to pull out $40,000, $60,000, $80,000 a year, all taxed as ordinary income, on top of your Social Security. That could push you into a much higher tax bracket than you ever expected, and there's nothing you can do about it at that point. You're locked in. So the real strategy isn't just about order, it's about smoothing your tax liability across your entire retirement. The smarter approach: tax bracket management. This is where things get really interesting. And this is the part that most generic retirement advice completely skips over. The concept is called tax bracket management, and it's essentially the art of deliberately controlling how much taxable income you recognize each year in retirement. So you never accidentally spike into a higher bracket, and you strategically fill up lower brackets when it's advantageous to do so. Let's walk through how this works in practice. Let's say you retire at 62 and you delay Social Security until 70, which, by the way, is often the smartest move you can make, because every year you delay past full retirement age increases your benefit by 8%. Between 62 and 70, you have an 8-year window where your taxable income might be extremely low. You're not collecting Social Security yet. You're not required to take RMDs yet. This is your golden window. During this window, instead of just burning through your taxable brokerage account, you should also be doing Roth conversions. A Roth conversion means you take money out of your traditional IRA or 401k, pay income taxes on it now, and convert it into a Roth IRA. You're voluntarily creating taxable income, but you're doing it strategically in a year when your tax bracket is low. If your standard deduction and other deductions bring your effective taxable income close to zero, you might be able to convert $20,000, $30,000, even $50,000 from traditional to Roth, while staying in the 12% or 22% federal tax bracket. That's an extraordinarily low rate to pay on retirement money that will otherwise be forced out of your account at much higher rates a decade from now. This strategy can save you tens of thousands of dollars, sometimes well over $100,000, over the course of a long retirement. But it requires planning years in advance, which is exactly why you need to understand it now. When to tap each account. The real playbook. All right, let's build the actual playbook. Here's how to think about sequencing your withdrawals across the different phases of retirement. Phase 1. Early retirement, ages 62 to 70, pre-Social Security. This is your window of maximum flexibility. Your income is likely at its lowest point in decades. Use it aggressively. Start by covering your living expenses from your taxable brokerage account. Sell assets with long-term capital gains. Ideally, if your income is low enough, you might even qualify for the 0% long-term capital gains rate. That's literally a tax rate of 0 on investment gains. Take full advantage. Simultaneously, execute Roth conversions to fill up your low tax brackets. Calculate exactly how much you can convert before you cross into the next bracket and convert right up to that line every single year. Reinvest the converted funds in your Roth IRA and never touch them unless necessary. If you have a Roth 401k from a former employer, roll it into a Roth IRA during this phase to avoid RMDs and gain more flexibility. Phase 2. Mid-retirement, ages 70 to 73, Social Security active. Once Social Security kicks in at 70, your fixed income baseline goes up. Now you need to be more careful because Social Security income is partially taxable if your combined income exceeds certain thresholds. At this point, reduce or eliminate Roth conversions if they're pushing you into higher brackets due to Social Security. Shift toward drawing down your traditional IRA and 401k intentionally, taking just enough to meet your needs while staying in a manageable tax bracket. Keep the Roth IRA as your emergency reserve and your legacy asset. Touch it only if you have an unexpected large expense, or if the tax math makes sense in a specific year. Phase 3. RMD years, age 73 and beyond. Now the government is involved. You must take RMDs from all traditional accounts every year, calculated based on your account balances and IRS life expectancy tables. If you've done the Roth conversion work in Phase 1, your traditional accounts will be smaller, which means smaller RMDs and less forced taxable income. This is the payoff for all that early planning. Use your RMDs to cover a significant portion of your living expenses. If the RMD is larger than what you need, reinvest the excess in your taxable brokerage account. Don't just let it sit in cash. If you're charitably inclined, look into qualified charitable distributions or QCDs. At age 70 and a half and beyond, you can donate directly from your IRA to a qualified charity, up to $105,000 per year. And that amount counts toward your RMD without being included in your taxable income. It's one of the best tax breaks available to retirees, and almost nobody talks about it. The Social Security equation. We have to spend a moment on Social Security because the timing of when you claim dramatically affects your withdrawal strategy. If you claim at 62, you get a reduced benefit permanently. If you claim at your full retirement age, 67 for most people today, you get your standard benefit. If you delay to 70, you get 124% of your full benefit for the rest of your life. And because Social Security is adjusted for inflation each year, a higher base means every cost of living adjustment compounds on a larger number. For most people who are in decent health and don't have an urgent financial need, delaying to 70 is the mathematically superior choice. Yes, you miss out on years of payments, but your break-even point is typically somewhere in your late 70s. And if you live into your 80s or 90s, which statistically one of the two spouses in a married couple is very likely to do, delaying pays off enormously. The reason this matters for withdrawal sequencing is that delaying Social Security creates that income gap we talked about in Phase 1. And that gap, paradoxically, is one of the most valuable financial gifts you can give yourself, because it's the window where you execute Roth conversions at low tax rates and set yourself up for a far more efficient retirement tax-wise. So don't just think about Social Security in isolation. Think about it as part of your broader withdrawal sequence. Common mistakes that destroy retirement wealth. Let's talk about the mistakes, because understanding what not to do is just as important as knowing what to do. Mistake number 1, draining the Roth IRA too early. The Roth is your most powerful tax-free asset. It grows tax-free, it withdraws tax-free, and it has no RMDs during your lifetime. Touching it in your early 60s because it feels like free money is almost always a mistake. Let it compound, protect it, use it strategically. Mistake number 2, ignoring IRMAA. IRMAA stands for Income-Related Monthly Adjustment Amount, and it's the Medicare surcharge that hits higher income retirees. If your modified adjusted gross income exceeds $103,000 as of current thresholds, you pay higher Medicare Part B and Part D premiums. These surcharges are based on your income from 2 years prior, which means a large Roth conversion or a big capital gain today could raise your Medicare costs 2 years from now. It's a trap that catches retirees completely off guard. Mistake number 3, not planning for a surviving spouse. When one spouse dies, the household goes from 2 sets of tax brackets to 1, and the surviving spouse is now a single filer, which means they hit higher tax rates at lower income levels. This is called the widow's penalty, and it's brutal. Doing Roth conversions while you're both alive and in lower brackets protects the surviving spouse from a massive tax hit down the road. Mistake number 4, treating all accounts as one big pile. Your accounts are not interchangeable. They have different tax treatments, different rules, and different strategic roles. Managing them as if they're all the same money is like treating a hammer and a scalpel as the same tool. You need to know which instrument to reach for and when. Mistake number 5, forgetting about state taxes. Federal taxes get all the attention, but state taxes matter too. Some states don't tax retirement income at all. Others tax it heavily. If you're in a high-tax state and considering a Roth conversion, the combined federal and state tax rate on that conversion could be 30%, 35%, or more. The math looks very different depending on where you live, and this is one area where working with a tax professional who knows your state is genuinely worth the cost. Putting it all together, your retirement withdrawal blueprint. Let's summarize the blueprint in clear, actionable terms. In the years before Social Security, live off your taxable brokerage account while aggressively converting traditional IRA and 401k funds to Roth. Stay within your target tax bracket. Typically, you want to fill up the 12% or 22% bracket without crossing into 24%. Once Social Security begins, scale back conversions and start drawing more deliberately from traditional accounts to manage your taxable income. Keep a close eye on IRMAA thresholds and your effective tax bracket. Once RMDs begin at 73, use those distributions as your primary income source. If they exceed your needs, reinvest the surplus. Explore QCDs if you're charitably inclined, and protect your Roth IRA as your legacy asset and your buffer against unexpected expenses. Throughout all of this, revisit your plan every year. Tax laws change, account balances change, health situations change. A strategy that's perfect at 63 might need adjustment at 68. The retirees who win this game aren't the ones who set a plan and forget it. They're the ones who stay engaged, adapt, and make small optimizations year after year. Retirement isn't just about having enough money, it's about keeping enough money. And the single biggest controllable variable in how much you keep is taxes. The sequence in which you draw from your accounts determines your tax bill, your Medicare premiums, your Social Security taxation, and ultimately your financial legacy. The good news is that this is entirely manageable if you plan ahead. The 8-year window between early retirement and RMDs is one of the greatest financial opportunities most retirees will ever have, and most of them have no idea it exists. Now you do. If this video helped you think about retirement differently, do me a favor and drop a comment below with your biggest takeaway. And if you're thinking about how this applies to your own accounts, tell me, are you more in traditional accounts, Roth accounts, or a mix? I read every comment. Hit that subscribe button if you're not already here. We publish new videos every week breaking down exactly how to build real lasting wealth. And I'll see you in the next one.